Hello there. Good morning or good afternoon. Welcome to the webinar. My name is Carey Wallace, and I am the owner of AgencyFocus, and I appreciate being invited by the Big Eye of Minnesota to share the the main KPIs that independent agents should pay attention to. So, for those of you that don't know me, I've been in the industry for about 16 years. I run an organization called AgencyFocus, and we provide independent agents with valuation, perpetuation planning services, financial consulting, fractional CFO work, all things financial. And this is one of my very favorite topics. What key performance indicators should independent agents pay attention to? If you don't realize this, there are more metrics in our industry than probably any other industry, and it's very, very easy to get mired in all the different statistics and metrics that exist. So let's first define what is a KPI or a key performance indicator. A KPI should be a number that causes you to take action. Rather than thinking of data for data's sake, it should be something that allows you to have an insight into your business and would incite you to either adjust, double down on an area, spend more resources there, less resources there, but take action. So key performance indicators should be actionable. They should definitely be measurable. It shouldn't be something that is a nebulous thought process, but something very measurable over time that you can compare and look at the trends of. It should be very timely. If it's a metric that you have access to, but you only know about it, like your financial statements, and you don't have your final financial statements until April, it's not very actionable because by the time you know that information, you can take very little action. So it should be incite action, be measurable, be timely, and maybe most importantly, it should be tied to your overall strategy. Therefore, when you look at that number, you can have an indicator of, am I on track or off track for the goals that we've set for the organization? And not only does that go for the owner, but if you're going to share your key performance indicators across your entire team, make sure those numbers tie to something that your team can relate to. Some of the big mistakes that I see business owners in general, not just independent insurance agency owners, but key mistakes that are made when setting what these key performance indicators should be is number one, they're just not specific or measurable. We set goals that say we're going to increase, but we don't say we're going to increase by 5% over this period of time. And therefore, you can't really tell if you've ever arrived where you're going to where you're hoping to be. So setting a metric that is not specific or not measurable makes it really difficult to know, are you achieving it? Is it something that you need to redo? Or you select some metrics that you can't have any influence or potentially any action that can be taken, and it really doesn't tie to driving you to take action, your team to take action. So if it's something that you can't influence or change, it's tough to make that a key performance indicator. One of the most um, for agents that understand that data is incredibly important, one of the biggest mistakes could be, I'm going to measure everything. And you come up with this whole list of different data points inside your agency. None of them are inciting action, and some of them you're not even sure what they mean or how they relate to what you're trying to do. So measuring everything could actually be worse than measuring nothing. And to that end, if you're going to set goals and you're going to put metrics in front of your team and they don't mean anything to them, then you're not going to have team buy-in to actually take action with those metrics. So if they're not tied to priorities, or you're measuring absolutely everything, it's really difficult to get your team to buy in especially if they can't influence the number at all. So when picking the numbers that you pay attention to, make sure it's something that you can influence, your team can get behind, it's going to cause you to take action. And I would ask myself, if I'm looking at certain metrics as an owner or the leadership of an organization, or even a producer or CSR, if someone's putting a number in front of me, if I can't say what action I would take to influence whether or not that number is where it should be or isn't where it should be, I would ask a lot of questions and say, why are we looking at it? What are you hoping that I will do to help the organization move forward? And what action should I take? And if you can't answer those questions, that's probably not a key performance indicator. It could be a metric, no problem, but it definitely might not fit the category of this is really a key performance indicator of my role, the organization's performance. So, as I said, we work with many independent insurance agents in order to be an extension of their team and help them in a fractional CFO role or a fractional chief financial officer role. And every single one of the clients that we have are engaging with us because they want to make sense of their financial numbers and they want to make sure that they're on track, and really that the plan they have for their organization is being translated into numbers, measured, and they can make adjustments in what they're doing in order to make sound business decisions. Our whole purpose in helping our clients is to simplify these numbers, provide clarity, and then help them make strong business decisions going forward. So the key metrics that every CFO client that we work with pays attention to are really only 5 metrics. And I'm cheating a little bit because I'm breaking one into 2 categories, but we make sure that every single agent is paying attention to their growth, to their profit, to their EBITDA, which is their operating profit, which I'll go into why that matters, revenue per employee, and spread. And this should give an overall view of how the agency is doing and whether or not you need to adjust your um, your attention or concentration in any one area in order to achieve your goals. Now, that one metric that I split into, I do look at growth and split it into what's being driven by new business and what is being driven by retention. Retention is so incredibly important inside an independent insurance agency, and it's really important to know, am I generating new business? Am I also holding on to the business that we have? How do I compare to industry benchmarks? How do I compare to what we budgeted for the agency? And how do I compare to last year? So while the core metrics are very consistent, how you compare to different standards will help you know and give context to each of these metrics. So I'm going to dive into each one and show you what that looks like. This is a standard dashboard that all of our fractional CFOs look at. We're trying to make it as easy as possible, not put a million metrics on the page and make it confusing. And this is just a simple one where we said, what is the growth rate year-to-date commission and fee income? What is your actual today? And what was the budgeted or the plan? And what is the percentage of growth that we see in that category versus the plan? So are we achieving what we thought we did in dollars, or what we thought we needed to do in dollars? Are we achieving it in the percentage of growth rate? And same thing, what is our retention rate? What did we expect our revenue retention rate to be? So all of these numbers are being compared to the budget. If I showed you one of my clients as of today, there's a third number below it that says, where were you this exact period last year compared to this year? So potentially, if an agency is not hitting their budget, are they still better than they were last year, is also another guide. So I'm looking at year-to-date growth rate in commission and fee growth, I'm not taking into account their entire revenue, because part of your revenue inside your agency is profit sharing or miscellaneous income. And those can vary greatly based on the performance of the agency, based on, losses. There's volatility in that number, but total commission and fee income is something that's very predictable. And therefore, I don't want the metrics we're looking at to be skewed by something that could be because of one major loss in the agency and skew that performance. So looking at just commission and fee income, the part that's predictable gives you what that growth rate is. Same thing with retention, and I'm going to tell you how to calculate that. And then what does my new business production look like compared to what I thought it should? Those things now give me line of sight to say, on the top line revenue, am I performing the way that I needed to, or do we need to change something? That might be where we're investing in marketing or investing in technology or investing in, some of our processes inside the agency. But that one line item could incite a fair amount of action based on that performance. Then we go to, how are we doing based on operating profit, your EBITDA, or just my overall profit, which is total income minus total expenses gets me to my profit. EBITDA is the operating expenses. We add back the expenses that are not related to operating the business in order to get a better line of sight on what that metric is. And then we talk about some capacity numbers. Revenue per employee and spread per employee are two metrics that the first one will give you an idea of, am I operating efficiently? And the second, spread, is a predictor of profitability. So those are two metrics that can be a gut check to say, am I understaffed? Am I overstaffed? Am I staffed for the growth that I expect? Am I in the middle of a transition? So is my revenue per employee different than what I thought it should be? And that spread helps us know, are we in the ballpark, and are we predicted to be profitable for the foreseeable period? Because spread is the calculation of your revenue per employee less your compensation per employee. And the reason why that metric is so important is it is the agency's ability to cover their largest controllable expense, which is people. And if you're in a position where your spread is where it should be, it's very likely that the rest of the expenses are also in line and the agency is positioned to be profitable. So that is one of the indicator things that you can watch to make sure that you are staying in line. So this is what our CFO dashboard looks like today, with the exception of, if I were to pull one up for one of my clients, they would have a third row comparing them to last year. Let's look into what you should think about for each of these metrics. So what is my profitability is something that agencies should ask themselves. I was talking to a client yesterday, and we were talking about the difference of how an agency operates from a profitability standpoint and what their tax strategy is from a profitability standpoint. So sometimes agencies have CPAs that advise them to put certain expenses through the agency in order to minimize their tax liability. And it might not be a true indicator of how profitable the agency can operate. So in order to calculate your profitability, you would get your total revenue less your total expenses is your profitability. But many agencies, when they have a different tax strategy that might be bringing that profitability down to minimize that tax, they also keep track of what discretionary expenses are running through their agency, or what expenses, if you want to think about it this way, what expenses would be eliminated from your financial statement if you were selling the agency. It's not essential to selling insurance or operating your agency. It's being run through there, but it's not essential for you to best serve your clients and sell insurance. So if you have that kind of tax strategy, it's oftentimes in a C Corp, for example, you should be able to track what those expenses are to get a true what is your potential profitability of an agency. Really, really important, and it's easy to do in QuickBooks if you create another department and track those expenses so you can see exactly what you're operating at for profitability and what your potential profitability would be. Organic growth rate is important to take into account. So the way to calculate your growth rate is in this period, I want to compare it to the previous period. So if I wanted my growth rate year over year, I would take my ending balance and revenue in 2025, compare it to 2024, and then divide it by 2024. So it'd be 2025's revenue less 2024's revenue divided by 2024. The most important thing about organic growth rate is if you've acquired an agency or you've sold a book of business, your two periods are not going to be apples to apples. So you have to remove an acquisition out of it, or you have to add back the book so you can get a true organic growth rate that's not skewed by a acquisition. So make sure when you're calculating your own growth rate, you take into account things that might skew that number. It's really important when you're comparing your metrics to the industry benchmarks that we're all talking about the same exact thing. So that's how you calculate both of those. And then when you're thinking about your organic growth rate, let's say your organic growth rate is strong, you compare it to the benchmarks, but there still could be risk in your agency with this number. And I call that the story behind the number that you should be asking yourself. So when you're thinking about the growth of the agency, number one, you want to make sure your growth rate and your retention rate are at or above what the industry benchmark is. Number two, you want to make sure it's at or above where you were performing last year or what you had budgeted for the agency this year. That's your first guide. And if you're off base on any of those things, you should ask yourself why and determine if there's action that you want to take. Then you want to say, okay, I'm hitting all those metrics, but is there risk of my future performance in this area? Where is my growth coming from? How likely is it to continue? And where is it concentrated? So, for instance, if an agency has two producers and both of those producers are at retirement age, let's say, well, there would be risk in their ongoing performance in this area if both of those producers that are responsible for all the new business decided to retire at the same time, or were unable to work and unable to come to the agency unexpectedly. So by asking yourself, number one, am I performing where I need to be? And number two, is there risk in the ongoing performance, allows you to think about what action you want to take to protect the agency. And is it transferable? So, is the ongoing performance of the agency in any given area expected to continue? And are there things that would cause it to not continue? So, I gave you an example of just the producer, but what if all of your new business comes from referral partners? And let's say your biggest referral partner is the real estate industry from mortgage lenders or real estate brokers. And all of a sudden, the interest rates double and nobody's buying homes. That would change what your expectation is for new business because your referral source has a stressor that's going to cause those referrals to start to not come in anymore. Or maybe you write habitational, same thing. Interest rates change, habitational activity changes, and all of a sudden the new business numbers that you have enjoyed no longer continue because your referral source changes. Or maybe you have a referral source that is at retirement age and they're closing business and they're not writing as much. So what they're sending to you is declining. So my point is, knowing the story behind some of these metrics could be what drives you to take action to create more referral sources or diversify your referral sources. But knowing where it's coming from, how likely it is to continue, where that concentration is, and how you can minimize the risk based on that concentration can help you ensure that you believe your ongoing performance is transferable and has as low of risk as possible. That is what drives the value of an agency. And I've started these metrics in order of what are the biggest drivers of the value of an agency, which is growth and profitability. But then all of them are what's the transferability and what's that risk. So that's how we think about organic growth. If you're growing by acquisition, you actually have two growth rates. You have your overall growth rate, and then you have your organic growth rate. It's important to know both, and it's important to know both so you can compare it to the benchmarks in the industry. Okay, so we talked about new business and what that looks like. Retention is one of the most important metrics, in my opinion, inside an independent insurance agency. The reason retention is so incredibly important, it is one of the differentiators of why private equity loves our industry, why agencies are so valuable, why multiples have stayed really, really strong in our industry, because we have enjoyed high retention rates because our customers typically don't change due to the fact that insurance is complex. The more policies per customer you have with an agency or with a customer, the more unlikely it is that they're going to change who they write their insurance with. So retention is one of the main drivers of value inside an agency. The higher it is, the more valuable the agency is. The more predictable it is, the higher the value of an agency. The problem with retention is many agencies struggle to know what their true retention rate is. And there's a couple of reasons why that is. So number one, agency management systems weren't really designed to give you good clarity on this number. Number two, agencies struggle to report it properly because they might not be consistent in how they record what's happening inside their agency. So for instance, in the middle of a hard market or coming off a hard market, there's a lot of rewrites. Well, if that's inconsistently reported inside an agency, and you actually have rewritten your policies from one carrier to another, but your download says new to the carrier, and that's put in your agency management system and not corrected to a rewrite, it actually downloads as new because it's new to the carrier. That will skew your new business numbers, and it'll also skew your retention numbers. If you're an agency that pays your producers a different commission rate on new and renewal, you could actually be overpaying your producers if that isn't caught on your rewrite. So the process around downloading and making sure that rewrites are recorded truly as rewrites and not as new will make sure that your data is clean and you have a clear view of retention. The second part that makes retention difficult is some business doesn't renew. So if you want to do the same way to calculate your retention, you would look at, let's say we're going to do year to date ended May 31st compared to year to date ended May 31st in 2024. What's my retention rate over those two periods? Well, I would need to take out my ending. I would say, what is my revenue 12 months ending May 31st, 2025? I want to take out any of my new business, and then I want to compare it to 2024. So what did I have eligible to renew and what have I renewed, and take out the new because that's new business. If I had a big bond book, let's say, in my 2024 numbers, and it wasn't eligible to renew in 2025, that retention rate will be off. So any revenue that was in place in the starting period needed to be eligible for renewal in order to compare to this period, or your numbers are not going to give you a clear picture of what your retention rate is. So period two, less your new, less any things that weren't, uh, period two, less your new, subtracted by period one, less anything that wasn't eligible for renewal, divided by period one, less anything that wasn't eligible for renewal, is the calculation to get to retention. That is true for revenue retention, for the customer count retention, for the premium. But revenue is the one where you have to make some adjustments to make sure that your starting number and the dividing number only reflect those things that were eligible to renew. So, and especially in this hard market, you can't just look at one retention rate and think that the agency is doing well. So, because there's been so much rate increase over the period of time, if you're only looking at revenue retention and not paying attention to your customer retention, you could be missing that there's some business that's going out the back door and the performance of the agency is actually not as good as what you think it is. Customer retention has also some challenges if one carrier has a package that has three policies, and when you wrote it with one carrier, they actually showed as three policies. You rewrote it to another carrier where it's a package and it's only counted as one. You can see how that data can get skewed and make it difficult for you to know your true policy retention and revenue retention. So just making sure that you create clear guidelines on how to calculate these things, how to measure it inside your agency, will put you head and shoulders above an agency that's unable to do that and unable to know their numbers. And you can see as you're managing that, you can say, do I need to do something different? Do I need to create a retention strategy in order to address a challenge? Is my growth rate down because of my new business? Is my growth rate down because of my retention? And if so, what am I going to do to lead the team and lead the agency to make sure that I'm hitting these goals? So there are other metrics that are indicators of retention. I mentioned earlier that the more policies per customer that you have, the greater the likelihood of your retention being higher, because the more complex it is, the harder it is for your customers to want to change anything about their insurance. So knowing your policy per customer is important, and going beyond that, your policy per customer for your personal lines customers and your commercial lines customers, knowing what those metrics are and comparing those to the industry benchmark can also help you have some guide into how am I doing and what is the likelihood that my retention will remain high. Some of the other things when you're thinking about your retention, if you've got clarity and you track something like a net promoter score, that could be an indicator to tell you how likely your customers are going to stay with you. How happy are they with your agency? And is there some action you should take in order to reach out to those customers that have a low net promoter score that might be at risk of losing the agency? That is a great way to help your team know which customers to focus on rather than treating all customers the same. Your number of monoline accounts, you might want to mine that inside your agency and say, that is an area where it's easier for your customer to jump ship. And if I minimize that and cross sell those monoline accounts, I, again, am going to increase my likelihood of having a higher retention. I might actually get rid of some of the accounts that maybe aren't as profitable for the agency. It's, again, some of these metrics and some of these insights help you make sure you're focusing your time and energy where you need to. You can identify some cross-sell opportunities by mining the data inside your agency. You can also tier your customers to know what level of engagement should you have across the agency. So I'm going to pause here so you can answer the poll really quickly, and then I'll move to the next slide. Awesome. All right. Looks like you guys were able to do that. Fantastic. All right. Okay. So we talked about our growth rate. We talked about how retention and new business both contribute to that. The next is, and we talked about operating profit. I've said EBITDA a couple times. EBITDA stands for earnings before interest, taxes, depreciation, and amortization. And honestly, when we think about the value of an agency, it's not a multiple of revenue, to be quite honest. It is a multiple of operating profit. And it is, that is one of the numbers, that is the number that gets multiplied by the multiples we talk about in order to get to the value of your agency. So if you have an idea of what your EBITDA is, you can have and that is the, of the two numbers in that formula, to get to the value of your agency, the EBIT is the one that you have control over. So the multiples in the industry are going to be what the multiples are. But this number is the one that you have full control over. You decide what your staff looks like. You decide how much you're going to spend on marketing, how much you're going to spend on your agency management system, how much you're going to spend for occupancy. You decide what those expense load is and what your operating profit's going to be. So the way that you calculate EBITDA is you start with your revenue less your expenses, which is your profit. And then you start adding back the non-cash things or the non-recurring things in order, or one-time expenses in order to get to what that operating profit truly is. So you'll add back any interest if you have a loan. You'll add back any of the taxes you paid based on profit of the agency. You'll add back any depreciation or amortization, which are accounting metrics that you need, as well as add back any one-time expenses that are not going to recur. Let's say you replaced everybody's computer in 2024. You'd add that back because you're not going to do that every single year. Or maybe you rebranded the agency or build a new website. You're not going to have those expenses every single year. You'll have the ongoing website expense, but not the build. Maybe you changed agency management systems and you had one-time onboarding. So any one-time expenses, you'll add those back. You'll subtract any one-time income. So let's say you sold an asset, you sold a book of business, or you sold a car that the agency owned. You would subtract any one-time income. Everybody had PPP loans a couple years back when we were in the middle of the pandemic. That was one-time income that was not going to recur. So you'll take that out. You'll add back any discretionary expenses, and then you're going to right size your owner compensation in order to match what the industry standard is for your size agency. So that could be an add or subtract depending on how much you put your owner compensation on your P&L as actual payroll and how much you take as a distribution. Once you've made those adjustments, you'll know what your agency's EBITDA is, how it compares to other agencies your size, and is there something I should do about allocating my resources to position myself to have a healthy EBITDA? The reason that's so important that you should be doing a gut check on this is that is how you determine the value of your agency. So if the standard agency should operate somewhere between a 25 and a 30 EBITDA, and you calculate yours and you're at 17% of your revenue is left over as an operating profit or EBITDA, you're about 10 points lower than than the average agency. And if you're expecting to get the same price for your agency as other agencies your size, but you're operating in a way that your profitability or your EBITDA is much lower than theirs, that's not a reasonable expectation. And it's something that you should have awareness of and be able to ask yourself, do I need to change how I'm operating the business? Am I overstaffed? Do I need to change, look at my comp structure? Do I need to look at how many locations I have? Do I need to, what are the things that are driving me being out of balance, and what are the things that I can do to maximize my value, whether I want to transition internally, whether I want to grow my staff and invest in the agency, whether I want to sell externally, whatever it is, should always be running your business like you're selling it tomorrow and optimizing what that value could be. And knowing that number can help you as an agency owner make some decisions. Okay, so we talked about some financial metrics. You have key teams inside your agency, and for those teams, there are leading indicators and lagging indicators on their performance, and they are so pivotal. They're the most valuable part of your agency. You should know what the metrics are that you should be paying attention to. And we want those metrics to be as meaningful as possible so those team members know we are on track, we are heading in the right direction. And if not, how do I adjust? So for a producer, most people pay attention to how much new business are you putting on the books? How much new premium are you writing every month? That is really the lagging indicator, because by the time that's done, the activity's done for the month. But if you were looking at, in order to hit your goals, if you knew how many calls they need to make, how many appointments they need to set, how many proposals they need to send out, and you knew the close ratios between calls and appointments and proposals, and so proposals sent and sales, then you could actually monitor how many calls, how many appointments, how many proposals, and they would be an indicator on whether or not we're going to hit that new business goal. And you could monitor that weekly. And if someone is falling down on their calls or appointments or proposals, that is a easy action that you could take to intervene and say, what's happening? How can we help? What are the things preventing you from getting that close ratio between calls and appointments? Do we need to listen to some of your calls? What's happening in these appointments that they're not turning into proposals, etc.? So a leading indicator is very actionable in the moment to be able to adjust. Lagging indicators are kind of, it's already done. Yes, you could adjust for next month or maybe go back and mine it, but no, having a healthy balance between leading indicators and lagging indicators really puts everybody on the same page and a higher likelihood of being able to predict whether or not we're going to hit our goals. So some of the sales pipeline metrics that you can manage, and I guess I also want to point out, it's really difficult for an agency to know close ratio, et cetera, if they don't have a CRM that manages their sales pipeline. Being able to say, how many quotes did it take? How many quotes turned into proposals? How many proposals turned into bound policies? If you don't have a system that's, how many calls turned into quotes or appointments or whatever your metrics are, if you don't have the ability to track those, it's really difficult to know those close ratios and be able to predict. So I think about a year and a half ago or 2 years ago, Catalyst did a study on what systems independent agencies are using. And one of the statistics was less than 18% of independent insurance agencies use a CRM or a sales um, uh, client, use a CRM that tracks these sales metrics. Well, if that's not something that you have, you might want to think about investing in being able to know these numbers. It helps you in setting up your producers, knowing what metrics and knowing what milestones to put in place. And we all know that producers are such a huge investment, and there's about a 50%, you know, uh, success rate in hiring producers, but those agencies that have these metrics and can manage to it are far more successful in having producers hit the metrics, both in a compensation, what they need and what the agency needs. So making sure that you have some of these, the ability to track these leading indicators can be a win-win for everyone involved. Some of the other sales topics to consider once you have these metrics is, do we know what's different between new sales and account rounding sales? Because that could skew your number. Do you know, again, back to that rewrites, are we sure that it's truly new business and it's not being skewed by your rewrites and falsely put in your system, skewing what that new business is? Do you keep track of where your new business comes from to know where that concentration is and that predictability of that? And that's super important for you to assess the risk that you have inside your agency if it's all concentrated in one place. And it also might give you something that you want to double down and spend more time generating more of that if that's something, more referral sources like the ones that are generating the results that you want. Do your producers have goals and consequences if they're not making it? If you don't have those leading indicators and all you have is what you've written, the response time for you to adjust makes it longer, and you've spent more time and energy as an agency owner, which makes it harder to add more producers because that validation time frame might take longer for you to make a decision. And then, do your sales and service know who's responsible for what? Do you have clear metrics for both teams to know exactly what's happening? Is there a new standard for new business onboarding and your renewal process? Is that super clean and easy to manage? These are all things that come out of some of the metrics that we're looking at. And how can I improve my process if we're off track in some of these areas? So, again, not all metrics are equal, but some give you insight to know where to pay attention to inside the agency. For the service side, I also wanted to point out some differences between leading indicators and lagging indicators. So, for a service person, one of the biggest lagging indicators is the end retention rate. But we already said retention might be difficult for the agency to calculate. So it could be the number of cancellations. It could be what new business they've done through cross-sell, the number of opportunities for cross-sell, or the number of monoline policies. You might be tracking by every CSR in the book that you manage. Here's the number of monoline policies, and the goal is to reduce it by 20% every single month. So what was the number, and did we reduce it? So some of the leading indicators could be, what are the number of referrals that each CSR is giving to the producer on opportunities that they found in the book? Are they providing them with cross-sell opportunities? Are they reducing those monoline policies? How many completed customer calls have we had, and what is the duration of each of those calls? So you can use some of these metrics to look at the activity, and then these lagging indicators to say, did those customer calls result in any cross-sold policies, a reduction in the monoline policies, the retention rate being where it should be, average policies per customer, is that going up as they cross-sell? So there's all kinds of metrics, but knowing the story behind them and which ones are the ones that can tell you, like if they're making 0 calls or their average duration of their call is less than 3 minutes, it's going to be really hard to make sure that that person's able to be effective in accomplishing some of these goals. So that's going to look different for every single agency, but think about, what am I tracking for my service team, and is it a leading indicator, is it a lagging indicator, and do I have access to something that would help me manage that different? I would be remiss if I did not mention that in this particular metric of revenue per employee or revenue per CSR or revenue per producer, capacity expectations in an agency is changing because agencies are leveraging virtual assistants. that are taking some of the administration or administrative work off of a traditional CSR, account manager, and producer. That should change your expectations for your producers, account managers, and CSRs, depending on how much of the work you're taking off of them. Automation is doing the same thing. Use of technology to create efficiency inside an agency is also doing the same thing, and so will the use of AI. So there is an asterisk, and you should take it with a grain of salt. If you're an agency that's very tech forward, that's using virtual assistants, and you're operating at the same capacity of those agencies, growth and capacity and efficiency metrics as an agency that isn't, your investment is not creating the return that you want. So adjusting your expectations for capacity and efficiency should be related to what you're investing in. And I will tell you those metrics are going to change, and they're going to continue to change as the environment we operate in and the impact of virtual assistant, automation, and technology and AI continue to change how we do business. No question about that. So I think we already covered this, but spread per employee, for the best practices agencies under 1.25 million in revenue, it's right around 70,000. And it really determines the cost of service provided. You want that revenue growing faster than the compensation rate. A wider spread means that the agency is more likely to have more profitability and more productivity than an agency that doesn't have a wide spread. The difference between the revenue per employee and the compensation per employee is how you calculate spread. So really important, as agencies leverage VAs, their cost is going to be less, their revenue should be higher, and spread should continue to get higher. As they leverage technology, again, there should take fewer people to do that body of work if technology is coming in and doing some of that work for them. Same thing with automation. If you've tiered your customers and some of the customers outreach is being done by your technology or your automatic processes, that efficiency should get higher. That revenue should be growing with less people expense. The spread should get higher and higher. So just know wherever you are as an agency and what you're doing could determine what the spread that you can expect inside your agency and how it compares to other agencies. As I said, there's so many metrics, and other metrics that many agencies may look to are listed here, but I would caution you, do not put a list of 20 metrics on a page and think that you're going to be able to manage to that. Like there, sometimes less is more, and make sure that whatever metrics you're looking at, it's causing you to have insights and where you should take action. But I'd be remiss if I didn't talk about some of the other metrics that our clients ask us to think about. So cost per customer is definitely on the minds of some agency owners. What is my profitability by line of business? Am I designed to be a generalist, or should I be thinking about specialization? And knowing my cost per customer and my profitability by line of business could help me make a decision there. What is my revenue split, and how is it changing over time? Oftentimes when we work with agencies and we're doing their valuation, we'll ask them, what's the revenue split? And they'll say, oh, I'm 60-40 commercial. And then they send us their book of business, and to find out they're actually not. They're more like 40, 60 the other way, but in their minds, they've been operating that way, but the complexion of their book has changed. So knowing what that is and how you're investing in the technology, the staff, etc., could really help you. What's your concentration by producer, concentration by niche, carrier concentration? All of those are risk factors that you should take a step back and run your book of business and look at that and make sure you're aware, where is that production coming from? And if you've got two producers that are producing crazy amounts, have you looked at the total book and how that's growing? And do we need to mitigate that to change the risk factors? Or do those producers need to train the other ones to figure out how to drive growth at the same rate? Number of calls, number of appointments, number of proposals, your close ratio. Really helpful to have a CRM in order to have that clarity. But those metrics are the most common ones that people ask for. There's no question around it. While you can look at way too many metrics, you also having none means you're not measuring anything and you're not managing to everything. So what gets measured gets managed. Make sure what you're measuring and what you're paying attention to ties to your goals, is meaningful to your staff, is meaningful to you, and there is some action that you will take if that number is not what you expect it to be. If those things aren't true, go back to the drawing board and come up with the metrics that will do that for you. And that's going to help you manage better, have the insights you need to make sure that you are focused on the right area. But definitely what gets measured gets managed. I'd love to find out what you're thinking about this. Number one, are these the metrics that you look at? Or do you have questions about what we talked about here? But I do want to tell you that if any of this resonated and you wanted to talk individually with anyone on our team, we have a partnership with the Big Eye of Minnesota. You have 30 minutes free to talk to anyone on our team about your agency. Be happy to answer those questions individually, or I'm happy to take some questions now. But that is what I have for you today. All right, Q&A. It looks like there's one. Can we get a copy of your slide presentations? Absolutely. Happy to send my slides, no problem. Are there any other questions? You can use the chat feature or the Q&A feature in order to send me your questions. All right. Well, oh, hang on one second. Is there a specific agency management system that you find works best for measuring metrics? I, the independent insurance agency has, agency management systems that are superior, unsuperior. Based on your size, I would tell you that some of the best agency management systems are Applied and AMS 360 and Hawksoft. But based on your size, your makeup, you have to determine the one that makes the best sense for you. For retention, that's really about process, not the actual agency management system. It's how you use the system and what processes you put in place. The retention, yes, the retention formula. So if you're looking to calculate your retention year over year, let's just say we're at 12/31/2025 and 12/31/24. You would take where you are revenue wise as of 12/31/2025, and you would subtract any new business. That gives you what business you've retained, not the new. So 12/31/2025 less new business subtracted from 12/31/2024, that number you need to reduce anything that wasn't eligible to be retained. If there's any business that would not renew, bonds is a perfect example. If you wrote life, that's not something that's going to renew. So what is the amount in 2024 that was eligible for renewal less your 2025 minus 2024 divided by 2024? Does that make sense? And I can actually send you the calculation written down so it's easy for you to be able to do that. But the key is identify what's eligible to be retained and then what did you retain, and make sure that you're comparing apples to apples. Should operating profit or EBITDA be used to determine the agency's eligible for profit sharing? Should operating profit or EBITDA be, so are you saying, do I include profit sharing in my profitability number and my EBITDA number? I think that's what you're asking me. So for our CFO clients, we actually give them their profitability with and without their profit sharing. In an agency, we all know that profit sharing is not guaranteed. If an agency is part of a network, cluster, or alliance, it's more predictable than an agency that is not part of one of those. But as you're calculating your profit, you should know what your profit is without contingency, and build your budget based on that, not based on counting on that profitability. When you calculate your EBITDA, we do include profit sharing or contingencies, but typically at a reduced amount based on your 5-year trend. And if there's been any changes with your carriers that would change the expectation of what ongoing profit sharing would be. So it's not completely eliminated, but it's definitely reduced in order to accurately predict what we think that would be. All right, I think I've answered that. If I did not answer that and you want to know more about that, reach out to us and I'd be happy to talk that through with you. Any other questions, or did I not answer one of your questions the way that you were hoping I did, or didn't understand your question? All right, let's see. Looking here and make sure I can see them. All right. Well, if there's nothing more, thank you so much for inviting me to share what the key KPIs are for independent insurance agents. I look forward to future webinars with you. And if you have any questions, please use this QR code, or you can visit our website and book a time there.
Thank you so much, Carey. Thank you for insightful lecture, and thank you everyone who attended the session today. I hope you guys had a great learning experience. Just so you know, we will be sending out emails for surveys, so please let us know how the session went, so that would help us improve maybe the format or anything that you want to be improved. And until then, have a great time. See you in next session.
Thank
Goodbye.
you.